Michael Burry is as infamous as an investor can get. Lots of people like to claim that he's a one-hit wonder, but to be honest, that couldn't be further from the truth. He was a medical doctor in training who started investing on his own and was so successful, his friends begged him to start a fund and make them money as well. He finally broke in 2000 and founded his firm Scion Capital at the start of the dot-com bubble. Now, it would have been easy for him to get swallowed up by the hype and to invest in pets.com just like everyone else, but instead, he predicted the bubble of a lifetime. He bet against it all, against all advice. 1 year later, after his first full year of running his fund, he had returned 55% after fees to his investors, while the S&P 500 was down 12%. He then continued to run his fund during the 2000s and consistently beat the S&P 500 for the entire decade. And we all know what happened after that. He predicted the housing market crash and made the investment of a lifetime, making billions for himself and his fund. Over the 8 years that his fund was active, he returned 489% to his investors compared to the S&P 500's return of 3%. He's been making a name for himself recently again, predicting another market crash to rival that of 2008. He's been tweeting his thoughts out regarding the index fund bubble, inflation and the Fed's money printing, the insane levels of debt in the economy, the crypto market, and the impending crash of the Chinese real estate sector. From his point of view, it's already a foregone conclusion. There's no doubt in his mind. The market has already crashed, you just don't know it yet. Today, we're going to go over and cover every single thing that Burry thinks proves we're on a one-way track to another recession, and by the end of it, you just might agree with him. But first, really quickly, if you're new to the channel, make sure to subscribe. If you enjoy this video, then hit that like button and leave a comment for the algorithm. Also, make sure to check out our Patreon. We're building a community of like-minded investors with loads of exclusive content, including buy and sell alerts for my own personal portfolio, so make sure to check that out. So, we start with inflation and the problems that it's destined to cause. The US government is inviting inflation with its MMT-tinged policies. Trillions more stimulus and reopening to boost demand as employee and supply chain costs skyrocket. This tweet right here mostly encapsulates Burry's thoughts regarding inflation and the Fed's money printing. Burry believes that the US is getting closer and closer to the world of modern monetary theory, where increasing the money supply supposedly doesn't cause inflation. Now, the idea behind MMT is that printing or spending excessive amounts of money doesn't necessarily cause inflation, and that as long as employment doesn't drop to zero, then inflation isn't inevitable. This idea has been getting more and more popular recently, especially in the aftermath of the quantitative easing following the 2008 recession. Basically, because we didn't see soaring inflation back then, people started to believe that QE could be used responsibly to stimulate an economy without causing other problems. The issue with this line of thinking is that QE did cause inflation after 2008. It just didn't cause consumer prices to rise that much. Instead, it caused asset prices to rise. All this money that was printed went flooding into housing prices, bonds, stocks, and even alternative investments like classic cars or Rolex watches, and it forced those assets up. Now, you might say that the same thing happened in 2020 in the aftermath of COVID and the lockdowns, and you would be right to an extent. We have seen huge asset price inflation, and it is largely due to the frankly ridiculous levels of QE undertaken by pretty much every central bank. Housing prices have risen across the entire US by 20% in 1 year. That is utterly ridiculous, and I think far too many people have been hearing that number and thinking that it's somehow normal and sustainable, but it just isn't. The average PE ratio for the S&P 500 today is sitting at 28 compared to the historical average of 20, which is 40% above that average. Now, some people will say that as long as it's only assets that are inflating, then it's not a problem. But we all know that isn't the case. Not even the Fed has the gall to continue to claim that CPI inflation is transitory, and right now, you'll struggle to find anyone who isn't at least a little bit worried about rising prices. Inflation is here. It is sitting well above any historical precedent at 5% in the US, and it's rising all across the world as well. It's not going to disappear anytime soon. Supply-side shocks may well be very real, and they may not be directly caused to the Fed's decision to print more money, but to be perfectly honest, it doesn't matter what the trigger for these supply-side shocks was. What matters is that they are here and they are causing us huge problems. At the absolute earliest, these shocks are going to remain until the end of 2022, and let's be honest, they're probably going to stay for a fair bit longer than that as well. That means a minimum of another year and a quarter of expensive shipping, empty shelves, and inflation that will continue to rise. No, the idea that inflation is transitory is dead. Inflation is here, and it's here to stay. And with that comes a whole new set of problems that are not looking any closer to being fixed. Now, unfortunately, just because it is now clear that the Fed has been wrong on just about everything over the last year, that doesn't mean they are just about to sit down and let the criticism mount. No, they've chosen to do their best to defend their reputation, and they've chosen to do so by manipulating the inflation data that we have regarding inflation. So, at Federal Reserve, are you lying to us or are you lying to us? Now, along with that tweet, Burry linked an article by the Wall Street Journal which documented the way in which the Fed was manipulating the inflation data to try and hide their failures. What Burry is pointing out here is that Jerome Powell chose to use a measure of personal consumption expenditure, or PCE, which throws out the top 31% and bottom 24% of inflation. And using that doctored data, the inflation isn't actually any higher than the Fed's targets. Now, the Fed claims that they use this data because they want to measure the inflation caused by their actions, but this doesn't make any sense. If they wanted to ignore inflation from, say, shipping costs increasing, then they just need to manually remove inflation associated with those rising costs. A broad stroke method of removing the highest and lowest inflationary measures doesn't differentiate the causes of inflation at all, and it only serves to make the headline inflation figure seem smaller than it is. Then there's the problem that the Fed is removing 31% of the worst inflation figures, but only 24% of the best figures. Here, I'm afraid, there is no justification for what the Fed is doing. This is plain and simple manipulation of the data. The Fed is staring us in the face and telling us that if we ignore the worst of the inflation that is happening, then there isn't actually any inflation to be worried about. On this point, it's practically impossible to argue against Burry. The Fed is manipulating the data, they are lying to us, and it's not something that we should ignore. To be perfectly frank, I'm amazed that the Fed has managed to maintain any kind of positive reputation after this year just gone. And that actually brings us quite nicely onto another problem that Burry has been warning us about. That is the index fund, or the passive investing bubble. Now, while this might seem, on the surface at least, to be basically the same problem as rising asset prices, the reality is that it's far more nuanced than that, and Burry views it as an entirely independent problem to inflation. Now, the idea of an index fund bubble isn't actually that new. It's been around for a fair few years now, and it's not too difficult to see why. The S&P 500 is the most widely invested in index in the world, and for good reason. It basically makes up the US economy and includes pretty much every major publicly traded company in the US and in a lot of other countries as well, and it's been completely dominant over the last 100 years. If you want an index that covers every different sector and one that will benefit from the huge growth of the most dominant companies in the world like Amazon and Apple, then the S&P 500 is probably the one for you. The only problem is that the S&P 500 has been growing far faster than the US economy or even the companies that make up the index. Very simply, this has led some people to suspect that there is a bubble in the market. Now, there are a bunch of different ways to measure this sort of thing, but the most popular way is the Buffett indicator. Unsurprisingly enough, its name comes from Warren Buffett himself, and it's a very brief measure that he uses to gauge whether or not the US markets are overvalued. It's very easy to use. You just divide the US aggregate market value by the country's GDP figures, and you get a ratio which shows you the value of those companies compared to the economic activity in the country they are based. Now, when you look at the historical readings, you can pretty clearly see why some people think there's a problem. On average, you'd expect the market's value to sit between 50 and 100% of the country's GDP. At the height of the dot-com bubble, the Buffett indicator sat at 150%, yet today it lies at over 230%. Now, it is worth pointing out that this measure isn't perfect. Compare the 1950s to today, and the largest companies in the S&P 500 are far more international than they used to be. Companies like Apple and Amazon operate and generate revenues in almost every country in the world, but their market values contribute purely to the S&P 500, so the Buffett indicator may not be as useful as it used to be. To be honest though, under pretty much any measure, the markets are overvalued. Take a look at price to earnings ratios or price to sales ratios or even forward PEs, and the story is exactly the same. The US markets are sitting at valuations that we've never really seen before. So where does this bubble come from? Well, according to Burry, it's a mixture of passive investing and leverage. You see, so many people these days are investing in index funds, and these index funds don't partake in price discovery. These funds buy the biggest stocks because they are the biggest stocks, and they inflate their values further. This leads to a positive feedback loop, whereby even more is invested in the largest companies because they keep getting inflated, which leads to even more being invested in them. Now, on top of this idea, Burry posted an academic article a couple weeks back that found that the markets aren't actually dictated by demand for stocks, but by the supply of capital, and this is where leverage comes into play. If $5 incremental market value results from $1 added to stocks and 90% of millennials are in passive market vehicles, that 5-to-1 ratio will get much sillier in time. The first step is to recognize that 5-to-1 is not a natural ratio. It is the produce of a paradigm. So what will continue this paradigm? What may reverse it? This is the knife's edge. Because we are at 5-to-1, it may go to 100-to-1 or become negative 5-to-1, but parabolas don't resolve sideways. So because of the existence of derivatives, margin debt and leverage, $1 being invested into index funds pushes the market up by $5, causing a parabolic rise. This also obviously leads to a market that grows at a far greater rate than the underlying profits or revenues which ought to drive it. Obviously, this isn't sustainable and it can't go on forever. But even this, according to Burry, isn't the end of the problems the markets are facing. Next, we have the ticking time bomb that is Evergrande and the Chinese real estate sector. Now, I'm sure you've heard of Evergrande, the second largest property developer in China that is saddled with $300 billion of debt that it can't pay. And in short, it's on the brink of collapse. Now, before you rush down to the comments sector, I know Evergrande just paid one of their notes due, but that really doesn't change anything. At the same time as they paid one obligation, they failed to pay a further two, and they are in the exact same position that they were in a week ago, staring down the barrel of a gun, just waiting for the trigger to be pulled. Now, while you might have only heard of Evergrande, there are far more companies just like it. Fantasia is another huge Chinese property developer who has been around for decades and who has over $10 billion of debts that it can't pay. And it just defaulted last week as well. Cynic is another billion-dollar Chinese property developer, and they defaulted on one of their obligations just a few days ago. China Fortune Land Development has debts worth $60 billion, and they defaulted all the way back in January. In the coming months, many more companies just like these will default as well, and you and I will get used to reading about this stuff on Bloomberg as it slowly becomes the norm. Yuzhou with $20 billion of debt will fail. Sichuan Lanjiang with $30 billion of debt will fail too, as will Raisun, Central China Real Estate, Guangzhou RNF, and many more, because they are all in the same boat. All of these companies took out too much debt to fuel their development of apartment blocks. They overpaid for the land, they overpaid for their debt, but because the Chinese property market was booming, it didn't matter. They were still able to make a profit, albeit utilizing some accounting practices that would be considered fraudulent, to say the least, in the West. Everything changed earlier this year, however, when the CCP basically made it impossible for these companies to take out any more debt with the 3 red lines policy. This policy put limitations on how much debt a company could hold in regards to its assets, revenues and growth, and despite the fact that the limitations weren't even at all strict by any standards, pretty much every Chinese property developer has found themselves on the wrong side of these new rules. The property market slowed down, and suddenly the assets that were supposedly more than enough to pay off these debts, these empty apartment blocks in empty cities which are owned almost exclusively by investors, halved in value, and so the companies were all instantly underwater. To some, this came as a surprise, but to anyone who's paid attention to the Chinese ghost cities and the ridiculous bubble that is the Chinese property market, this was all totally obvious from a mile away. Now, as this collapse spreads, and it will over the next year or so, the CCP will attempt to prop up the markets with things like liquidity injections and state support, but it will not be enough to prevent the entire industry from collapsing. The real issue with all this is whether or not the problem spreads. Burry seems to think that contagion will take place, that it's already started even. China as a whole uses up 40 to 70% of global commodities, and the property market in China alone accounts for 20%. What happens to those commodities if the industry slowly shuts down over the next year? What happens to the companies which produce and trade in these commodities? What happens if the entire Chinese economy enters a recession on the brink of this industry's collapse? And what happens to the banks that lent these hundreds of billions of dollars to Chinese developers? And what happens when the insurers who will have to pay out when they fail? People claiming that because the markets didn't instantly crash on this Evergrande news, that the problems are all overstated, are just wrong. It took Lehman Brothers 2 years to collapse after the mortgage-backed securities failure, and we shouldn't expect Ping An to roll over and drop dead within a week of bad news just because it's Chinese. Burry definitely thinks that this will take a year or two to develop, and I'm inclined to agree with him there. And finally, we have Burry's thoughts and fears about the crypto markets, which are no small fish either. Now, there are a few misconceptions here. A lot of people seem to think that Burry has been short in Bitcoin, but there aren't actually any financial statements to suggest this, and Burry actually just came out and said that this wasn't the case either. Now, that doesn't mean that he thinks the crypto markets are fine. He almost certainly doesn't. Burry's fears around crypto do seem to be concentrated on the leverage at play in the system and just how little we know about it all. Now, it's not exactly breaking news that an over-leveraged financial system is often the catalyst for a recession or a crash. Go back 50 years and you couldn't count the number of times it happened on both hands. But at least with traditional banking, it's possible to measure and detect leverage to try and gauge risk. With crypto, it is a whole other ballgame. Because of how unregulated the market is, it's just not possible to have any kind of accurate idea as to how much leverage is in the system. Obviously, there are margin traders from the big exchanges, places like Binance or Coinbase, and it might be possible to squeeze some data from those exchanges to try and find out what kind of leverage they are dealing with. But what about the 1,000 other exchanges who don't have so much as a single employee in a Western country? What about the 1,000 borderline scam sites which the US government doesn't even know exists? What about options on those fringe exchanges? What about artificial exposure to crypto? What about people borrowing money from their family or buying crypto on credit cards? The truth is that we have literally no idea what goes on in the crypto markets, and the likelihood is that it is embodied by leverage. We just don't have the faintest idea by how much. Crypto is volatile enough as it is. But when you add options trading, leveraged futures, and who knows what else, the risk of a negative feedback loop and a downward spiral cannot be ignored, at least according to Burry. Add on to that the belief that Burry has regarding Tether, their fraudulent activities, and the fact that they likely have huge exposure to Chinese commercial papers, and these issues with leverage and the crypto markets cannot be ignored. They are systemic, and they could be the catalyst, or at the very least, further fuel for a crash. Now, I know that Burry is often classified as a perma-bear here on YouTube, someone who predicts far more crashes than he should, and that he misses more than he hits. But I also know that this isn't the case. He is an incredibly successful investor in his own right, and people who try to claim that he's a one-hit wonder or a perma-bear are merely trying to attack him to discredit his beliefs. The truth of the matter is, I really don't care if people think that or if they comment that under this video. The only thing that matters to me when talking about Michael Burry is where he is putting his money. Reading and analysing his tweets can be great, and it can give us some insight into his plays and how he's thinking, but if it isn't backed up by trades, then it needs to be taken with a grain of salt. What I am seeing with his fund right now are bets against US treasuries, bets against the tech market in the US characterised by ARK Invest and Tesla, bets against the US economy as a whole characterised by the S&P 500, and even bets against the crypto markets. I don't agree with everything that Burry has to say, but that doesn't mean I should ignore what he has to say either. If we ignore all alternative views, we force ourselves into echo chambers which only does a disservice to us all. If you disagree with anything said here today, then explain why you disagree with what has been said. Don't just attack Burry, call him a perma-bear, and ignore anyone who asks you to elaborate. If you're new here, then consider checking out our Patreon. We're building a community of like-minded investors where we can talk and discuss all kinds of ideas just like we do on this channel. You also get access to loads of exclusive content that isn't available anywhere else, early access to all videos, private live streams, and buy and sell alerts from my personal portfolio, and you can help support the channel for as little as $1 a month. On top of all that, once we reach 100 patrons, I'm going to hire a full-time video editor to help me put out even more content just like this. If you enjoyed this video, then make sure to subscribe. If you want to help spread the word, then consider liking the video and leaving a comment, and YouTube will do its part by pushing this video out to more people just like you. I really do appreciate all the support you give the channel, even if it's just leaving a like. There's also a link to my other channel in the description as well that you can check out. In the description, there's a link to my favorite brokerage called eToro, where you can trade stocks and shares, crypto, commodities, foreign currencies, and more, all for 0% commission. There's also a link down below in the description to BlockFi, where you can get up to $250 in free Bitcoin, and you can earn interest on whatever crypto you hold. Whether it's Bitcoin, Ether, or stablecoins, you can earn as much as 8% interest a year. Thanks for watching. Stay stoic. Until next time.